Good afternoon, everyone. Hopefully you've managed to find your way through Microsoft Teams okay. So thank you very much for joining. I hope you're all keeping very well during these somewhat strange times. Just by way of quick introductions, I'm Josh Levy, Chief Executive of Ultimate Finance, and I'm delighted to be joined here, virtually of course, by John Lightfoot, Head of Client Service. If you wish to ask any questions, please use the chat functionality on the screen, and we'll either pick questions up at the end or follow up directly afterwards. If you want to leave your name, that may make it that easier as well. For those of you that attended our webinar a few weeks ago, maybe a month ago, regarding guidance on all the government support schemes, you'll recall I made reference to our desire at the time to look to increase the support channels we have for you as our valued clients. As such, we're delighted to have been able to announce yesterday that we have been formally accredited by the British Business Bank to join the Coronavirus Business Interruption Loan Scheme, which I will shorten to CBILS, otherwise I'll tongue twist myself, as an approved lender for term loans alongside invoice finance and construction finance facilities. We expect to begin lending under this scheme on Monday or Tuesday next week. Our priority is to support our clients where eligibility criteria permits, and we wanted to give you an introduction to all of this today, just so you are prepared in case you require any support as such. So, quick agenda. We'll start with an overview of the scheme and its features, along with a comparison with the bounce back loan scheme that was launched by the government earlier this week and has taken quite a bit of commentary in the media. We'll then take you through detailed criteria set by the scheme rules and our own internal rules before John explains our approach, our process, and information requirements from here should you be considering applying for a facility. So first, the scheme itself. Many of you will be very familiar with it, so I'll keep this brief. CBILS, as you know, was established in March to support the continued provision of finance to UK businesses who have been negatively impacted by the coronavirus outbreak. It's very much delivered in a partnership way between the government and what's now 60+ accredited lenders, delivered by the British Business Bank as the conduit. The scheme itself supports lending of up to £5 million to SMEs across a range of product types, but so far it's mainly been used for simple term loans, mainly delivered by the high street banks. As of a week ago, and I think there's figures due today actually, over £4 billion have been provided to over 25,000 businesses. There have been lots of issues and lots of criticism of the banks for the way they've been using the scheme, some of which is valid, some probably less so. The way it works as a whole is giving a government guarantee to lenders of 80% on outstanding loan balances for any loans covered once the proceeds of any recovery process has been obtained. So it's very much a loan and not a grant. As a borrower, you would remain fully liable for repaying the loan as with any other loan. What it does give you as a borrower is fee-free lending for the first 12 months. So any upfront fees and interest payments are covered by the government under their business interruption payment. As lenders, we would pay a scheme access fee, which is calculated as a percentage on every new loan provided with the guarantee. So the use of this, it's mainly for new lending purposes. There's also a chance to refinance facilities on the same lender or kind of consolidate debts, again subject to some pretty tight designated limits and restrictions from the government. The rules changed pretty early on to remove the ability for personal guarantees to be requested on loans of less than £250,000, although they still can be used for facilities above this. Indeed, taken security itself is encouraged by the government under the scheme where it's available. This slide highlights the differences between the bounce back loan scheme and the CBILS scheme that we're accredited for. So the bounce back loans are for up to £50,000. It's capped at 25% of turnover with 100% government guarantee, and there's no interest or capital repayments due in the first 12 months. And thereafter, it's followed by an interest rate of just 2.5% a year. So very attractive terms, a very quick process. Given the 100% guarantee, basically it removes the banks from any contingent liability. CBILS has a minimum loan size of £50,000 plus one. Is essentially the scheme for anyone looking for a larger loan. And really that means any business with turnover over £200,000 that meets eligibility criteria should be considering CBILS if they need more than £50,000 of funding. So a business is not able to take out both. So if you take out a bounce back loan scheme facility, you're not able to go and get a CBILS facility and vice versa. So it comes down broadly to a consideration of the speed, ease and low cost that comes with bounce back loans versus the amount of funding that can be generated, which up to £50,000 can be limited in some circumstances. So really it's taking a quick and easy 50,000 if you're above the 200,000 turnover limit, maybe at the detriment of what a business actually requires or can get in the future. And just to be clear, we're only accredited for the CBILS scheme. The bounce back loans are pretty much just limited to the high street lenders and the banks. So highlighted here is our proposition and how it works. So we will be offering term loans above £50,000 up to £500,000 to both new and existing invoice finance and construction finance clients. The term loan benefits from the CBILS guarantee, so the 80% guarantee you can see there, whilst the invoice finance facility doesn't benefit from the guarantee, so it remains on the same basis as it's currently written on. So as you know, for those of us who've been with us some time, we're a secured lender. We don't, by definition, do unsecured facilities generally. So we've spent a lot of time thinking about what businesses need and how we can assist our clients. So what we're doing through this is offering something that I genuinely believe the SME community needs. We've termed it here survival and then revival. So it's the combination of both, coupled with the ability to offer debtor protection and other asset-based lending solutions that we have in our toolkit that we believe makes this a compelling and somewhat necessary prospect for many businesses. So I don't need to convince you guys of the benefits of invoice finance. There does remain a misconception in the market about what it is and what the benefits are. So whilst term loans will enable businesses to plug temporary cash holes and ensure survival, really then what happens next? So how do you look to the future? And we think working capital facilities, which invoice finance is, will be vital to support any cash flow and working capital needs as we return to some form of normality, whatever that may be. But basically as sales grow and debtor books build out again, but costs come back onto the P&L, all in advance of receipt of payment through invoices. And that's where invoice finance clearly can make a big difference. So from our standpoint, there's no better solution for combining quick access to flexible funding that grows in line with turnover with personal relationship support. So this is something that does not exist within an overdraft, even if you are able to obtain one from a bank, and it certainly doesn't exist with a term loan on its own. That's why the combination of both is what we're going with as our proposition. And coupled with this, debtor protection. So this is available as required to give a full package of both funding and also protection against non-payment by your customers or their failure. Many of you will have this. I would encourage you to consider the merits of doing so. If you don't have this within your facility, your relationship manager will be able to help with any requirements there. So we've covered some of the key features, but I just wanted to emphasize a few of the key points here. So we won't be doing standalone loans. We're only offering CBILS term loans to invoice and construction finance customers, both existing customers and clients, and any new business that comes our way. There are quite rigid scheme rules and criteria that must be met, as with any other government scheme, as you'd expect. And then there are our own internal set of criteria. So the loans, the CBILS loans, are capped at a maximum of 25% of your invoice finance facility limit. And again, there's another set of criteria from the BBB, which is that the loans are capped again at the greater of 25% of turnover from 2019 and double 2019's wage bill. For the term loans themselves, our proposition is 3-month capital repayment holidays as standard, alongside the 12 months interest-free period where the government's picking up the interest, and there's no setup fees, and importantly, there's no early repayment fees. So there's the ability to get a 3-year term loan with no fees and charges in the first year, other than 9 months of capital repayment, and then no early repayment charges at the end of that should you wish to repay early. So I'll cover the scheme criteria in details, but just before we get into the nitty-gritty, these are the 4 main components. So the applicant must be a UK business with a turnover of less than £45 million, and it had to have been a viable business pre-coronavirus, but negatively impacted by what's happened since. In terms of our criteria that sit on top of the scheme rules, these are the key ones. So again, I mentioned this, but existing or new invoice finance or construction finance client with a facility limit of over £200,000, minimum turnover requirement of £1.5 million. We're determining viability through a few things, but mainly whether the business was EBITDA positive in 2019. Affordability is the other critical component. So we're using our calculation as a coverage ratio of 1.5 times EBITDA adjusted for dividends and any ongoing interest payments, and that has to cover the full capital and interest repayments. So the way we look at this, clearly not paying interest for 12 months or capital for 3 months is very helpful for cash flow, but cash flow forecast must demonstrate two things really. The business will be able to service the loan and also repay the loan when it's due. And we kind of look at two angles there. So one is what sensible and explainable assumptions are the forecast predicated on, and also historical evidence. So again, looking back to 2019. And finally, the fifth one here, no evidence of particular stress or strain on creditors or HMRC pressure before this. There's obviously some flexibility there. And this is a key one, no history of financial crime or fraud. So I'll skip through the detailed criteria, much of which is covered by the British Business Bank's eligibility criteria that you may have read already. It applies to all lenders and can be condensed into 10 pretty clear guidelines, which I'll just take you through now. So the first one, has the borrower been impacted by COVID-19? So the SME must confirm that it's been negatively impacted by COVID-19 to be considered eligible, and that comes through in two ways really. So it's a self-certification, and then we sense check that certification. Secondly, does the SME have a viable business proposition? So the SME will need to demonstrate the business was a viable entity as at December 2019 pre-coronavirus, and the criteria to evidence this is based on a positive EBITDA figure. We will, in appropriate circumstances, continue to look at turnaround situations and consider that as potentially viable, depending on how that viability is demonstrated as at the December 19 snapshot. Number three, has the lender assessed the security of the SME in line with scheme criteria? So firstly, as we talked about before, no personal guarantees to be taken on CBILS loans of less than £250,000. Tangible security may be required, particularly where a CBILS loan is greater than £250,000. So the fourth, is the borrower an SME and not an individual? So the borrower must be an SME, a trading business, and they cannot be an individual. We're only lending and offering CBILS loans to limited companies. Number five, does the SME generate more than 50% of its turnover from trading activity? So eligible SMEs must be generating or expect to generate more than 50% of income from trading or commercial activity. This is not designed to capture shell companies. Number six, will the facility be used to support trading activity in the UK? Clearly, it's a UK government scheme. The facility must be used to support trading or commercial activity here, and providing the facility does that and supports UK activity, it can still be eligible where income comes from exporting. It doesn't automatically make it ineligible. Number seven is a slightly strange concept here. So is the SME an undertaking in difficulty? So this is fairly prescriptive and somewhat confusing terminology based on EU state aid rules that sit behind the scheme. What it does, it states that if a business is classed as one of these three things as of December 2019, then they are not eligible. So the definition includes businesses that have got accumulated losses of greater than half of its subscribed share capital, businesses that had entered insolvency proceedings, and businesses that have previously received rescue aid. Number eight, does the SME have a turnover of less than £45 million? So again, we talked about our minimum being 1.5 million, and the maximum of the scheme is £45 million. Number nine, is the facility within scheme terms? So this is coming back to the 2 times wage bill and 25% of turnover based on 2019 numbers, as well as our own internal criteria, which limits the term loan size to a maximum of 25% of your invoice finance or construction finance facility limit. And finally, is the facility being used for an eligible purpose? So the eligible purposes include a few things. So whether it's new or additional finance for working capital, whether that's just a contingency, investment needs, and in some limited cases, refinancing of existing debt or debt consolidation. So the maximum of 20% is a pretty prescriptive defined rule by the government scheme. So we've covered most of our internal criteria already, so I probably don't need to go through this one again. We can move on. I will hand over to John to explain what happens for you next, should you wish to consider applying.
Okay, thanks a lot, Josh. So I just want to highlight how we're going to use the CBILS proposition that we've put together to support our existing invoice finance and construction finance clients. Apologies if there's a little bit of repetition with the things that Josh has said previously. I'm very conscious there's a lot of information to take in here, so hopefully we'll all benefit from that. So as Josh mentioned, the intention of CBILS is to assist the cash flow of clients that were viable prior to the COVID-19 outbreak. We hope to confirm our official launch next week, and your relationship manager will be your key point of contact throughout this, explaining our criteria, assessing eligibility, and ultimately completing the application for you. You'll need to help with gathering the information requested as promptly as possible to allow them to progress your application. As a business, we'll be allocating significant underwriting resource to this, and we'll be hoping to progress applications as promptly as we can so we can get funds flowing to you, our clients, as quickly as possible. I'd also like to highlight the bottom point there, that you may be able to refinance existing loans onto a CBILS loan. This next slide outlines the information that we require to progress your application. I'd like to highlight the need, as Josh mentioned, for a minimum of 12 months cash flow forecast for sub 100k loans, and that for loans over 100,000, we'll be looking for a fully integrated set of financial forecasts. That includes a P&L, balance sheet and cash flows. We've got a template that we've developed in-house that we can provide you with that may help you fill this out and provide us with the information we're looking for. Also, your relationship manager may look for other information as deemed appropriate that'll help support the application that they make on your behalf. This next slide covers off the pricing and security that we'll be looking to take. There will be no change in pricing of your invoice finance or construction finance facility. We'll adopt a risk-based pricing model to the CBILS loan itself, with rates starting from roughly 1% per month. In terms of security, again, point Josh made, the key point is that there's no incremental personal guarantee on CBILS loans below £250,000. However, additional security may be required for loans above 250,000, and there will be a right of set-off between the invoice finance facility and the CBILS loan. This slide then goes on to give an overview of the application process itself. If you're interested in the CBILS loan following this webinar, please in the first instance contact your relationship manager for an initial chat. They'll assist you through the application process, ensuring the loan is serviceable and outlining all the information we require and the various steps in the process. Once your facility is approved, the legal documents will be created and the legal pack will be sent across to you for signing and execution. We'll get the system set up and payout will be made as quickly as we possibly can. If your application isn't successful or we're unable to help, we will look to point you in the direction of people who may be able to assist you. For loans less than 50,000, you should initially look for a bounce back loan via your main bank. If you're looking for more than 50,000, you could try your main bank or approach alternative lenders specialising in unsecured CBILS loans. Just before I hand you back to Josh, I would like to reiterate the point. If you're unsure of anything you've heard so far, or you've got any questions about anything you've heard, or how we can help you at the current time, please do contact your relationship manager in the first instance. They'll be more than pleased to hear from you and help as and when they can.
Thank you, John. So for me, just 3 concluding points on our proposition. We believe we've got a distinctive product combination across term loans, invoice finance and debtor protection that will allow businesses and SMEs to get through what is undoubtedly a difficult period, but also keeping an eye on the future and planning for what those future working capital and cash flow needs may be. Clearly, if we can be of assistance to you or you'd like to discuss your options, please speak to us, as John just mentioned. Secondly, our proposition really centres around our core strength, which is around service delivery, which hopefully you'll recognise. This is where the power and value of our relationship management team comes in to work with you to provide the support you need when you need it. And importantly, we are ready to go from early next week. We've designed a slick and easy process to enable this, and as John talked about before, we've adequately resourced all of the right teams so that we can make sure this happens quickly. So the timeline at the bottom, very condensed. Obviously, the announcement was yesterday, and we're hoping to go live on Monday afternoon, if not Tuesday morning. So that's really where we are. I just want to pick up a couple of questions that have come in. So the first one is on whether we'll be getting accredited status for bounce back loans. So the difficulty with bounce back loans clearly is the cost that's prescribed by the government is below the cost of capital for many lenders, including ourselves. So the 2.5% interest rate is not something we can ever compete with, which is why the scheme will pretty much just be limited to banks and some challenger banks who may have access to deposit money. So you've seen Starling have been accredited today, but mainly it's been limited to the high street names. And the second question, just to pick up on, is around the definition of EBITDA and what this means. So I appreciate this may not be common language for many people, at least it shouldn't be. So EBITDA is earnings before interest, tax, depreciation and amortization. Again, too many words, right? What is it? So it's operating profit added back depreciation and amortization. So again, speak to your relationship manager. We have financial templates that can help you calculate the key terms that we've got here, and it's really quite simple once we just get into the detail, and so you have the support from us as you need it. And that's everything we've had through on the Q&A on the live event. If there's anything else, please either get in touch with us through your relationship manager or one of us, and we'll look to answer as quickly as possible. Otherwise, we'll let you know on Monday when we're live, and please do get in touch as and when you need help or assistance or just to consider your options. Thank you all for joining, and have a great weekend.